There's been a lot of buzz surrounding a report that was issued by Goldman Sachs earlier this week regarding their expectations for the stock market over the next decade. The report, which was discussed in a Bloomberg article that was released on Monday titled, "Decade of Big S&P 500 Gains is Over, Goldman Strategists Say," points a grim picture for stock market investors. According to their company's analysts, they expect that between now and 2034, the S&P 500 will only provide an average yearly return of 3% per year. They also see roughly a 72% chance that the benchmark index will trail Treasury bonds and a 33% likelihood that they'll lag inflation throughout 2034. The article rightfully points out that we here in America have been pretty spoiled over the past decade in terms of total stock market returns. Between 2014 and 2024, the S&P 500 provided an average yearly return of 13%. This is much higher than the typical long-term average, which is between 9 and 10% per year. The S&P 500 is also on track to outperform the rest of the world in 8 of the last 10 years, according to data that was compiled by Bloomberg. This year alone, the market is up an incredible 22%, and it's up nearly 90% over the course of the last 5 years. But all of these incredible returns, at least according to analysts at Goldman and one other financial institution I'll touch on later, are going to slow down pretty significantly. So what is their reasoning for this gloomy prediction? Why do they expect returns to slow down all of a sudden very quickly? The biggest argument in this article, I think, was the fact that the market is astronomically overvalued right now. It does make sense for stocks to be higher due to technological advancements and better productivity. But stocks as of right now, especially tech stocks, are trading at values that are so high they make little sense. There's a number of ways analysts look to see how overpriced the market currently is, but one of the more common things to look at is called the CAPE index. CAPE stands for Cyclical Adjusted Price to Earnings Multiple, and it compares stocks' current prices to average earnings. As you can see, the stock market right now is considerably expensive, being close to its second all-time high. The main culprit for this latest boom in the market has been AI stocks, which obviously include companies like Nvidia, arguably one of the most overpriced stocks in the market today. Now, I think it's really important to point out that in this article, Goldman is not predicting a stock market crash. That's not the main focus of this article. What they're suggesting is that while returns have been great, it's historically unlikely that they will continue to be as good as they have over the last decade. And what we could be looking at is a period of very underwhelming or flat returns. Because times have been so good for so long, many investors, especially younger investors, might not even be aware that there are occasionally very long periods of very minimal or flat stock market returns. Nobody ever wants to be told that eventually the party will come to an end, but it does happen. I've shown this chart of the Dow Jones Index over the course of the last several decades in previous videos. But you can see that during the 70s, that entire decade was basically lost in terms of market returns. Although this was many decades ago, investors need to know that it can happen again. Just because this happened over 40 plus years ago doesn't mean it can't happen again or won't happen again. Goldman's chief U.S. equity strategist David Kostin even went on Bloomberg talking about the potential of a lost decade of returns.
So what we focused on in this report was what's the probable total return that an investor should anticipate for the cap-weighted S&P 500 index. And the conclusion was a range of somewhere between negative 1% and positive 7%. Midpoint of that is around 3%. What is the driving force behind that thought process and that analytics? Well, there are two issues. The first is valuation. We know when the market trades at a high multiple, a high valuation, that the next 10 years is typically low relative to an environment where, say, the multiple was low at the beginning. You tend to get a pretty strong return in the subsequent decade. So we're sitting here with a cyclically adjusted PE multiple that's different from a forward one-year multiple. Based on the cyclical adjusted earnings for the last decade of 38 times. That's the 97th percentile versus, say, the last 100 years. So it's a very, very expensive starting point. And what's new about the analysis is that we also include a variable for concentration. We're in one of the highest concentration markets in 100 years. Top 10 stocks, for example, comprise around 36% of the index. It's an extremely narrow concentration. And historically, when you have a high concentration market, you have a relatively muted return in the subsequent 10 years.
So ultimately, what should investors make of this Goldman Sachs report? People have been talking for years about the fact that stocks are very overvalued compared to their long-term average. That's nothing new. And the most common belief for a while, I think, has been there's going to be some kind of stock market crash or a major correction. Or at least that seems to be what's really popular here on YouTube as of recently, with so many videos now popping up about a major stock market crash incoming. But again, Goldman Sachs is not claiming there's going to be some kind of crash or a major correction, just a slowdown in stock market returns to allow companies to catch up to their fair values. But Goldman Sachs isn't the only financial institution that's predicting a major slowdown in future stock market returns. Apollo Global Management's chief economist is also predicting a major slowdown in S&P 500 returns. Ultimately, history has shown us that these incredible stock market returns simply can't last forever. They just can't. People don't like to hear that, but eventually the euphoria always has to slow down at some point. With all this in mind, I want to show everyone a really important chart that I've shown a few times in the past, but it's really important if we are going to see 3% returns or sideways markets for a while. And that's the impact of dividends on the overall market. This was made by a company called Hartford Funds, and you can see what's been responsible for the vast majority of the stock market returns of the past 63 years, which are dividends. Historically, people who target dividend-paying investments have seen better returns on average than those who don't invest in dividend-paying stocks, index funds, ETFs, and whatever. If we're going to be looking at a sideways market for the next decade, it's going to be really important to focus on dividend-paying investments, especially since they're the biggest source of returns in the first place. Even your friends who love index funds owe a lot of their returns to compounding dividends being paid. This report highlights the fact that investors need to consider other options in order to avoid a potential slowdown in their returns. Not only should dividend-paying stocks fare better, but this is likely going to be a great opportunity for the higher-yielding asset classes. A mostly flat market would mean that investments like preferred stocks, closed-end funds, covered call funds, and BDCs would shine in these kinds of environments. A number of these investments are known for performing relatively flat, at least from a share price perspective. But all of them offer dividend yields that range anywhere from 6% on the low end to over 12% and even higher. If we're looking at only 3% returns, the next decade could be a great moment for these alternative investments. Holding a closed-end fund that doesn't move much in terms of share price, so it's basically flat over the long term, but at the same time offers a yield of almost 10%, would beat the S&P 500 by a lot if Goldman Sachs is correct with their prediction. Reinvesting those dividends would additionally create a snowball effect, which could bring even better returns in your portfolio. So if the S&P 500 provides lackluster returns because of how long the markets have been so overvalued, these higher-paying dividend investments will become one of your only ways of securing returns that are much higher than what they're forecasting. If you haven't already, give this style of investing a try if you're new to this strategy. Odds are that if you're a more passive investor, you'll like receiving the cash payments you'll get from these holdings. But with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher-yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.